Hey fools, I'm Deidre Woollard. I'm an editor at Millionacres, which as I hope all of you know is the Motley Fool's real estate investing arm. And so in the next half hour, we're going to talk commercial real estate. And I'm here with Rick Kalvoda, who is the Senior Executive Vice President of Advisory at Altus Group. And Altus Group is a leading provider of software, data solutions, and it's a platform for commercial real estate assets. And the reason I wanted to have Rick on today is because they recently put out this Global Property Developments Trend Report, and it goes into all the things that are happening in commercial real estate. They published one in January, and then this is an update, and obviously the picture has changed a lot. So Rick, thank you for joining me.
Thank you. Welcome. We're glad to be here.
Awesome. So let's get into it. So yeah, the picture has changed dramatically. And one of the things I wanted to ask you, because I think it's interesting in this report, is the picture for commercial real estate here in the US is different than it is elsewhere around the world, right?
Yeah, so it's actually very similar trends that we're seeing. So we are global. We're across the different markets, the different regions, APAC, EMEA, as well as the US. And so some of the trends are relatively similar. It's just the degree that we're seeing in terms of changes in valuations, changes in underlying values. So we have insight in about $1 trillion worth of real estate, that's commercial real estate that's valued every quarter. And the trends, whether it's how it's impacting warehouse and logistics versus retail, that's similar, but just how much it's being impacted is really relative to how much coronavirus has impacted the different regions. So even though APAC was impacted first, the degree it's impacted the economy has been less, and therefore the impact to the underlying real estate is less as well. But the one thing that is very similar is just the uncertainty that where we're going to be 6 months from now, a year from now, because things can change very quickly when it comes to COVID-19.
Absolutely. So in terms of transactions, commercial real estate transactions, I've noticed that commercial real estate transactions here in the US have gone down a lot. It seems to be a little bit different in Europe and in the Asia Pacific regions. Is that what you're seeing as well?
Yeah, they haven't been as impacted much. And if you think about it, especially the first wave, the US has been impacted more. And so there's more uncertainty, there's more immediate impact on the underlying fundamentals. And also just doing the transaction itself, the social distancing, the lack of travel, you can't go out and do your due diligence on that. But transactions also, when you look by property sector, we've seen more transactions on logistics, on warehouse, and even multifamily, where there's a little less uncertainty there. There's also some positive trends that have occurred from COVID. So if you think of e-commerce and online shopping, the warehouses, and then on the flip side, much more need for price discovery because there's less transactions with retail properties as well as with office as well. And that's the whole thing. What happens with work from home, going forward is a big question right now.
Oh yeah, we're seeing that a lot in real estate and real estate investment trusts. We're seeing industrial REITs do really well. Data center REITs obviously do really well. And then where we're seeing things be weaker is retail and also hospitality. One of the reports I read recently said that, as many as 25% of hotels in the US could be, facing foreclosure or something like that. So I think there's a lot of activity going on in terms of people thinking about where there might be opportunities. And is that something you're seeing as well? Is that some companies are amassing capital and kind of looking to take advantage of a weaker market?
Yeah, no, absolutely is. We saw that back with the GFC as well in 2008, 2009. There was a lot of capital sitting by the sidelines, waiting to take advantage of, if there was disruption in the market, if the prices go down to a level where there was opportunity with the distressed assets. We're not seeing that yet. Part of it is, if you think about it, and part of the stability in the markets overall has been with the government stimulus, with the Fed, the low interest rates and the amount of money that's been put in the system. There's a lot of capital out there looking for an investment. And even with some of the disruption to the bottom line, the NOI, the return, the underlying income return of commercial real estate, it's still a relatively attractive investment relative to bonds and even stocks in some cases because of that income component, even if there's near-term volatility with the income.
That makes sense. So in your report, one of the things I noticed is that tenant/occupier expectations are shifting a lot, and that changing how different commercial real estate developers and landlords think about leasing. And I know one thing that I've seen is that leases themselves are changing. Can you explain a little bit about how tenant expectations are changing?
Yeah, it's definitely ultimately when it comes to development, it's what's the demand for that real estate, which is comes
Hmm.
from the tenants and the occupiers. And again, if you look at different asset classes, the demand for that in retail, very questionable going forward
Right.
and there will always be some physical, retail component, but it will likely be less than what it is right now. We've said for about 10 years is with retail, wasn't so much an oversupply scenario, it was under demolished situation, is that there
Mhm.
was just too much retail out there, and that's
Right.
been that's been a trend that's been happening, and will likely continue, but won't go all the way. And it's really ultimately who are the tenants and how much demand is there. And you think about offices, and that's a big a trend going forward as well, is what post COVID, how much work from home, how much will work from home impact the demand for physical office. And it's not only how much, and then also where is that demand. And so you hear a lot about the migration from the urban centers out to the
Hmm.
suburbs, and how much is impacted there by tenants. What are they going to be looking for? That I think will take a little bit to play out post COVID, that post vaccine. But retail definitely will see that trend. And then logistics on the opposite side, there's still strong development demand there, just because there's strong demand. And your other question just with leases is how leases are structured. So that with retail, big questions as to if a retailer, if the building is closed and the retailer can't open their business, do they need to pay rent? And so you'll see leases being restructured from that perspective as well.
Well, you mentioned an interesting fact about offices. So a lot of our investors are invested in office REITs, and obviously work from home has changed in the short term. Do you see that as a long-term thing or something that is going to shift back a little more toward normal in the next couple of years?
Yeah, I think one, I would say that's probably the biggest question we have out there across the different
Mm.
sectors. That's the one that internally, even a lot of people are trying to figure out what the extent of work from home will be. I think back to an earlier comment, I think there definitely will be a shift back more to normal, but definitely not back all the way to normal. So that leaves a broad, area that, you could drive a truck through. But I think there will be changes going forward. So instead of, just a small percentage of your workforce working from home, you'll have an increase in the number working full-time from home. Um, and the rest you'll probably see, instead of not working from home at all, you'll probably see 1, 2, maybe up to 3 days a week that work from home, because you can't. I think what's happening right now is being forced. You need that, that culture. You need that connectivity and the collaboration that comes about being in the same physical space. So you definitely will see a return back. I don't think it'll be full normal, but it'll be close to normal than what it was before.
I hope so. So I wanted to ask a little bit about trade regulations because your report obviously looks at global trends. Trade issues were sort of bubbling up before COVID and have sort of backed off a little bit, but could come up again. I know the price of lumber is rising. There's concerns about the price of steel. How is all of that impacting whether or not people are going to build right now?
Yeah, it definitely goes into the underlying, feasibility of a development project. Construction costs, not only the materials but the labor as well, is a huge component of what determines what the viability of a development project is. So the more changes or increases you have in those costs, that impacts the viability of a project. And so you may see some projects never moving forward, potentially even some projects being paused, partially because of the cost, but then also because of the demand side as well. But then labor, as well. So you talk about
Mhm.
tariffs on materials and availability of materials, but then also labor is a significant component, whether it's the physical distancing on site on the development, especially when you enclose the building, that has a big impact on it. But then just also the availability of labor, and to the extent that immigration or or anything else that impacts the number of laborers and the skill sets of those, that's going to have an impact on the cost and viability of a project as well.
Well, I know before COVID, a lot of people were talking about skilled labor, skilled construction. The average age of the construction worker is keeps rising. I know that there's been different companies have put out initiatives to try to get younger people and attract younger people into the trades. And do you feel like that's something that still is going to be a concern? Obviously, the unemployment market has shifted a little bit. Has that made things easier for people to find more workers?
I think because the trend over the years has been for more skills needed for construction, you can't just immediately shift someone, into the labor force. It'll take
Right.
years, and I think that's been happening, and that'll, continue to happen. I think also and that was part of the report as well, just the technology side of it. So more robotics, more modular development, where you build parts of it in a facility, in a warehouse, and then bring it to the site to make it more efficient, less labor intensive. I think you're going to see more trends, with that as well. But also just the availability of labor is, I think it's something that really impacts, it's really a demographic, wave, where as the baby boomers are retiring, almost any industry you pick, it seems like, especially on the skilled side, there is a concern about the age of the average, skilled worker in that, industry. But then you have the millennials coming behind it, and you'll see a lot of that, fill in, the demand for that as well. Maybe a little less so on the labor side, on the construction side, but as that becomes more skilled, then the younger generation will fill that gap in more there as well.
Well, and I feel like modular plays a role there too, because I think for the younger generation, it's easier to imagine themselves working in factories, assembling things using technology versus being on a construction site, with a hammer. And I think one of the things that is really changing is that construction, in my opinion, and I don't know if you agree, has been really slow to be disrupted. We've seen disruption across all other fields. We haven't seen it so much in construction. Do you think that this what's happening now is going to maybe help speed some of that up? You talked about technology earlier. Is that helping?
Yeah, I think absolutely. And I would even broaden it to where real estate as a whole has been much slower to adopt technology and automation. And we internally, we're more of a prop tech company. Prop tech has been very big over the last several years.
Yeah.
But if you go back, we're probably, real estate overall is probably still 15 to 20 years behind the other asset classes. If you look at stocks and bonds and some of the other components. So real estate as an investment, but then also real estate, the physical, aspects of real estate is, yeah, absolutely. It's definitely has been slowed. I think as robotics, as technology, algorithms, machine learning, AI, as that becomes more and more, better and improved, you're going to see that take hold of sectors like real estate, where it's been slower to adopt, and then even to the point where it's with robotics specifically on the development site as well. And I can even go back, at some point we will see inflation, and real estate is a good inflation hedge, because costs go up, and therefore the values of the underlying real estate goes up. You'll see those as costs goes up, it becomes more important to be more efficient on development, so you can keep costs down, and that's where you'll see more and more of the technology come in, just to have for the developers to have a differentiator, have an edge on the development process.
Yeah, I'm really fascinated by what robotics can do. I've seen some of the robots that can lay bricks, and there's obviously 3D printing. There's different groups that are making those 3D printed houses that use concrete, and even construction, sort of like almost androids that can hammer nails and do things like that. So, do you feel like the construction site of the future is kind of a hybrid of traditional construction and then sort of more integration of robotics and technology?
Yeah, no, absolutely. And you can liken it to, you think of a warehouse 30 years ago, the number of people in that warehouse,
Mm.
manufacturing and building things, to the manufacturing plant of today. It's much more robotics. It's more, and a lot of times it's just a few individuals overseeing and monitoring those robotics. So I think we're definitely, now there's always, it will take a while before that comes, and how quickly, and it will always happen. You don't expect it. It's taken a while. All of a sudden, boom, it's there. And so it's definitely going to take, quite a few more years. but it'll be here, I think, sooner than most people think, just because of the advances that have been made over the past 5 years.
Well, and I liken it a little bit to self-driving cars, is that part of the issue of adoption of self-driving cars is that you also have regular cars and regular people on the same roads. And I think with construction, there's also that too, is you have to build for the middle ground before you can get to maybe the end result where it's more technology than people.
Yeah, absolutely. And that's probably where, it's a great analogy with the autonomous cars. I think that definitely will be here sooner than, most people think. And if you think about it, the construction site's a much more controlled environment than out on the road with, bikes and, with pedestrians and everything else and all the other drivers. Whereas a construction site, you can definitely control that more and just like in a manufacturing plant. So that'll be an edge, to help the adoption of that as well.
Absolutely. So one of the things that I'm looking at right now is in the US is the potential for a second stimulus. Obviously, everyone's sort of waiting on that and also on government legislation in general. When Altus looks at the sort of world view, are you looking at other things like that happening around the world to maybe boost real estate development in the coming years?
Yeah, absolutely, because that is how quickly things turned earlier this year, just a month or two, after our lockdown, after the U.S. Lockdown, is can largely be attributed to the $3 trillion plus that was put into the economy and the resulting low interest rates. So looking specifically at multifamily, is even though the NOI has declined, not as much as everyone expected, again, partially because of stimulus, but it declined. The amount of capital available, whether it's lending or investors looking to get in because of the inflow of capital after that, it definitely impacted the values of multifamily and apartments. As you go around the world, all governments around the world have done some sort of stimulus, some sort of infusion of capital or lowering of interest rates. And that has a big impact on value. So we are following that very closely around the world. And I would say that's more near term. We're also following, nothing comes for free. So what's the impact of that a year down the road, 5 years down the road, just the amount of debt. And at the same time, before this, we not only had a lot of debt, but a lot of the unfunded liabilities out there as well. And so areas like Chicago, which is from a government perspective, is probably more impacted by unfunded government debt, unfunded liabilities of the government, is we're seeing that impacting, relative to the other parts of the country, impacting real estate. And I think that's something that's going to, especially now with COVID and the amount of money that has been spent and the amount of lack of revenue coming in from governments, it's an acceleration of how soon they're going to have to deal with that issue as well. And so that's something we're focused on as well. Again, more medium to long term. Short term is how much more stimulus, and it definitely will come. Is just how much and when is the question there.
Well, and I think another thing that this, obviously we've had to put funding toward this, but another thing that, especially in the US, that we really need to start funding is infrastructure. And I'm wondering if the changes in infrastructure are also going to have an impact on this. One of the things I wanted to ask you about is transit-oriented communities. So before COVID, a lot of money, a lot of interest going toward public transportation hubs, building around those areas. Is that going to change with work from home?
There'll still be demand for that, development around the TODs, the transit-oriented developments. There'll still be demand for that, but I think it will be impacted, and it goes back to the urban centers as, and this isn't a new trend, as millennials have aged and, they kind of drove the demand more to the urban centers and that lifestyle. As they're aging now and looking to buy a home, raise a family, get married, you're seeing some of that trend go back to the suburbs. And so I think there will be slightly less demand, for TODs, for development around those hubs, just because urban, on the margin will be less than what it was before. And again, the trend was already there. It just was a very small trend. COVID, I think, will accelerate that slightly. ultimately, the New Yorks, the San Franciscos, the LAs, even the Chicagos, there will be a long-term demand for that. So while that backs off and there may be a lesser demand, I think ultimately it'll return, more medium term, because it is something that the urban centers will be there. And you look over the millennium, as there's been more and more of that. Humans are social, beings, and they want to be in areas and what the urban area brings. So to answer your question is yes, the demand will come back slightly, but I think it'll return eventually.
And I think even before COVID, one of the things that we were watching was the rise of secondary and tertiary cities here in the US. And this whole urban exodus thing is definitely having an impact on San Francisco rents and New York rents. Is that something you see too? And do you see the rise of these kind of smaller cities as an ongoing trend?
Yeah, no, absolutely. And you're right. It's been, for a while, the Austins, the Nashvilles, the
Hmm.
Raleighs, and as more and more of and especially as the students come out of colleges, and a lot of these areas have good colleges in that area, that's where the employers want. If that's where the ultimate staff, the people that they hire out of school, want to be located, that's where they're going to move. It's a better quality of life. I think as the urban, you could say, it was almost overdone, as the demand for real estate in housing in the New Yorks and the San Franciscos reached a level where the trade-off of being in an urban center like that, the lifestyle, the restaurants, the nightlife, all that, the trade-off of now you can only afford a very tiny apartment, or you shared it with several people. The trade-off of that is now shifted more to those other tertiary markets. And again, COVID, I think, accelerated some of that. I think that will continue as well.
I think anyone who had multiple roommates during the pandemic is now rethinking that. So I think there's definitely a need for space too. And so the other trend this year, or the other thing that has really been sort of in the spotlight this year, has also been the environmental impact. We've seen fires in California. We've seen, it's been a big active hurricane season. When you look at it long term, and what are you seeing developers thinking about, and what is Altus thinking about in terms of giving people information about potential for climate disruption in certain areas?
Yeah, that's definitely something that over the last few years has become more and more important. There's been something out for a while, TCFD. It's financial disclosures on the impact of your company, and even down to the real estate. We're working more closely with owners of real estate as the tenants, and really even the owners of real estate are looking for more information about where their building is, whether they're in a hurricane area, a flood zone, or an area that could be impacted by wildfires, collecting more and more information around that. And not only just where you're located, but what the potential impact could be. So investors are more and more looking at stress testing their portfolios. What if this happens? And it's not even just, while it might be higher insurance costs related to owning, something in a area that's prone to flooding, it's not only just the cost of the insurance, it's the insurability. And you're seeing that in Florida, where some of the insurance companies are actually leaving the state, and they're not, and I've experienced this personally, is they're not reinsuring properties there if their roofs are more than 15 years old, if they were built before, because they're not up to the current standards. And as you see more and more liabilities for the insurance company as more and more of these events happen, it's impacting that. So what we try and do is, back to the prop tech, is the data, the transparency, and the analytics around that data, helping clients understand what their potential risks are related to the environment.
Well, you brought up an interesting point, which is the insurance factor. One of the things I've seen in California, in certain rural areas, certain insurers won't insure people, and so then people have to rely on the state plans. So, I feel like that we're going to see that when fires hit a place over and over again, as potentially something to be concerned about.
Yeah, absolutely. And if it's, one or two major events a year, the insurance company overall can, handle that. When you have
Hmm.
multiple insurance and tens of billions, of dollars, in some cases hundreds of billions of dollars of impact, there's only so much they can raise all insurance, to cost for that. So they will have
Right.
to start focusing on where is the greatest liability, where is the greatest risk, and adjust premiums, or whether or not they even provide the insurance there. And absolutely, California is one of them. As California has grown, it's gone more into the mountainous and the wooded areas and in the forested areas. That's where there's more of that risk, and probably hasn't fully been reflected in the insurance premiums. So you'll see more of that, especially after a year like this year. You'll see more of that coming through, and will impact where future development will be, and also where it will be, and also what type of development, to make sure it or to help protect against it. If there is an event, how do they protect against it or limit the damage associated with it?
Well, that's a really good point too, is like in Miami, for example, I've seen the buildings, commercial developments that maybe have a lobby that essentially is prepared if it floods or something like that. So is that something that you're seeing as well, that there's changes in the developments themselves?
Yeah, no, absolutely. And this even goes back to, where hotels in Hawaii have for a while, they're prone to tsunamis or typhoons or rising waters. Is the lobby same thing? Is the water can come splashing through, they squeegee it out and put the furniture back, and they're right back, to normal. So I think you'll see more, and that's, similar with the hurricane areas of Texas and Louisiana and that, where they put, just individual houses up on stilts, and hurricane, sustainable or development for hurricanes with the roof and the walls and how they're connected. Out here with earthquakes, and that's where, it's been a while since we've been impacted by earthquakes. I'm actually in California, but where we've been impacted by earthquakes is, all it takes is one of those before it gets people thinking about that again. But over the years, from 20 years ago, big changes in how the development is done, here in California as well.
Of course, and that then changes zoning codes and things like that. Obviously in Florida, we saw that too, with different changes to the building codes to protect against things like that. So as we wrap up here, we've got a couple minutes left. I kind of wanted to talk to you about 2021. So, we're in the fourth quarter. What is your company thinking about? What are you feeling about next year? And what can we look forward to or be warned against?
I mean, that is the big question right now. I think, again, I think it goes back to is how we write out the short term will be the level of stimulus, when we get it and how much. Again, I'm pretty confident there will be something. It is needed. So I'm actually more concerned about 2022, 2023 and beyond, is because you can cover up the short term, concerns. It's what happens after that in terms of how do we pay for all this, and how does that impact, the individual, the state governments, local governments, the cities, and how do we fund the, for 30 years we've been looking at the impact of Social Security, and at what point will it no longer be sustainable? You have that on top of the government debt, on top of the amount of baby boomers that are retiring. A lot of that just caused a lot of concern in terms of how is that handled going forward, and then how does that impact investments, and specifically real estate investments is a big question. So near term I think is great. I think the one sector of commercial real estate I'd focus on or look at is office. And again, post COVID, what happens there? That's the biggest question. And then e-commerce is just a wave that's going to continue, a trend that's going to continue big time.
So is there anything in terms of, you mentioned technology, what one technology piece for real estate are you kind of most excited about?
I'd say, and maybe this is a little bit specific to myself or to Altus, is the data. The amount of data that's now being collected on whether it's the development, whether it's the operation of building, whether it's the financials of a building is just phenomenal. Data science, data scientists is a big term now that's in the real estate industry. It's been for a little bit, but given how big the commercial real estate market is and getting bigger, there's more and more dollars getting into it. And even I'll just mention quickly with single family homes, single family rentals, just such a huge wave that we're seeing right now, amount of capital going into that. Data and the analytics on that data is going to be a huge component. So that's, I would say, the exciting thing I'm seeing specifically in investment real estate, commercial real estate now.
Awesome. Well, thank you. This was great. So people can go to altusgroup.com to get the report. Is that correct?
Absolutely. Yep.
Okay, great. Well, thank you very much.